Hello and welcome to our update on 4D infrastructure. My name's Jonas Daly, Head of Wholesale Sales at Bennelong Funds Management. So I might just kick off first question for Sarah. So Sarah, what are the key characteristics of global listed infrastructure assets?
Yeah, look, put simply, infrastructure offers the basic services essential for communities to function and for economies to grow and prosper. For 4DI, that basically refers to the publicly listed operators of essential services, such as electric utilities, gas utilities and water operators, as well as user pay assets, such as toll roads, ports, airport operators. The essential characteristics that make this infrastructure for us are resilient and visible cash flows, often underpinned by contract or by regulation, a monopolistic position or at least high barriers to entry for other operators to come in and compete, an inflation hedge, and high upfront capital cost, but then followed by very low maintenance cost expenses. For us, this makes infrastructure a defensive asset class, but it also offers investors higher visibility of earnings and lower volatility of earnings relative to broader equities at a higher dividend yield. So while infrastructure is defensive, it offers that defensive attributes, we also think infrastructure offers a huge growth potential for investors.
Oh, so Greg, so tell me about the global need for global listed infrastructure.
There's been huge underinvestment around the world in infrastructure by all nations, both developed and developing nations, over the last 30 years. This has led to a huge backlog in a need for infrastructure spend, and there's been various estimates. So for example, the B20 Business Council indicates that something like 60 trillion needs to be spent over the next 30 years just to bring infrastructure up to scratch. So you put that with an enormous need for infrastructure spend around the world, and you combine that with the fact that governments, generally speaking, are cash poor. They're running big fiscal deficits. They've already got lots of debt. Means that you've got a big need for infrastructure, but you've got cash-strapped governments that basically can't meet that need. So what does that mean? That means there's a great opportunity for privately financed infrastructure to take up a big part of that void. And what we mean by privately financed infrastructure is both unlisted infrastructure funds and listed infrastructure funds, such as ourselves. So a huge opportunity for the market to grow more generally and for people such as ourselves to participate in that opportunity.
Okay, great. And what's exciting about some of the opportunities in infrastructure?
I think as Greg mentioned, there's a huge need for new investment in infrastructure around the world. This coupled with what is pretty fragile public fiscal positions globally means that those infrastructure operators that have the balance sheet, they have the expertise and they have the willingness to invest can really capitalise on this opportunity to invest in the asset class. Look, we're sitting in a pretty sluggish global growth environment, and this means that governments are also again looking at stimulus packages. One of the biggest beneficiaries of stimulus packages is the infrastructure. As a perfect example, Japan, who is really trying to get their economies moving, has just announced an additional 3 trillion yen to fast-track their maglev project. And this is part of what they think could be up to a 20 trillion stimulus package involving infrastructure. We take this need and this global growth environment that's pretty sluggish, we actually couple with that with the fact that interest rates are likely to stay lower for longer. This really supports increased investment and increased big capital investment here and now, which supports the infrastructure investment. So for us, the defensive, resilient earnings streams that these infrastructure operators already have, the need for this investment, their willingness to invest, and the balance sheet and the credit markets support of that investment is a perfect storm for infrastructure operators to capitalise on the opportunity and the need for that infrastructure investment.
And how do you think the global listed infrastructure will help fill the gap of that funding need?
Well, as I mentioned earlier, the funding need will be met by both listed market and the unlisted market. Now, the listed market is pretty aggressive in some of their bidding for some of the assets as they become available, but nevertheless, the public markets will still participate in them. So, for example, in New South Wales at the moment, we're seeing the privatisation of a number of electricity assets. Now, they've run into a few political issues, but the first round of them saw Spark Infrastructure, a publicly listed company, participate in the privatisation process. Another privatisation process underway, certainly a different sort of agenda, is in the US water and wastewater sector. So that's a unique market in the sense that it's predominantly, in the US, water is provided predominantly by local municipalities. So there's something like 53,000 water providers in the US, which are very small municipalities. But the problem they're facing is that they need a lot of capex spent on water in the US. So for example, some of the water pipes in the US are over 100 years old, yet they're still in the ground and still being used. So as a result, they need a big capex program, but these local municipalities, just like the point we made earlier about government struggling financially, these local municipalities are struggling to meet that capex spend. So what are they doing? They're basically selling their little small businesses that can be only as small as 100 or 200 customers. They're selling it to the big listed utilities, the listed water utilities in the US, which is allowing them to grow and then therefore fulfill, in answer to your question, fulfill the funding need for infrastructure going forward in the public markets.